yes, the labor market continued to weaken in the first half of this year. I think that part of that was due to uncertainty over policy. We might have had the biggest tax hike in history, and so maybe there were firms holding off on investing until the tax bill was done. And we also had the biggest rearrangement to global trading policy in half a century. And so while those deals were being negotiated and people were waiting to see where tariff rates would shake out, it wouldn't be surprising to me if they held off on making some decisions. So I do think that uncertainty is a potentially helps explain some of the weakness we saw in the first half of the year. And then really until last week, I'd been operating under the assumption that a lot of that uncertainty had dissipated. The tax bill had become law, and trade deals had been made for most of our large trading partners. And then, last week, China decided that the deals that had been made earlier in the year in Geneva, London, and Madrid no longer bound them. And so I had been operating under the assumption that the uncertainty had dissipated, and that therefore I felt more sanguine about some aspects of the growth outlook. And now potentially this is back. Because the Chinese are reneging on deals that were earlier made. And so I think it's incumbent upon us as policymakers to think about the introduction of a new tail risk. And the tail, the left tail has become a little fatter, as we might say. And we have to recognize that, there potentially is some difference now versus where we thought things were a week ago. And therefore adjust policymaking.
Downside risks to growth.
There's now more downside risks than there was a week ago, and I think it's incumbent upon us as policymakers to recognize that should get reflected in policy.
Isn't it a little early to conclude that?
Oh yeah, it is early to conclude that things are actually changing, right? But it's about where the balance of risks has moved, right? And risks exist now that didn't exist a week ago, that didn't exist a month ago.
I mean, you wanted much lower rates a week and a month ago. So do you want even lower rates now?
No, I wouldn't say that I want even lower rates now than I did a week or a month ago. However, with the change to the balance of risks, I think it becomes even more urgent that we get to a more neutral place in policy quickly, as opposed to sort of waiting for downside, as opposed to waiting for downside data to materialize. To the extent that I think that policy is quite restrictive right now, that sets us up to be vulnerable to shocks. And if you hit the economy with a shock when policy is very restrictive, the economy will react differently than it would as if policy was not as restrictive. And so I think it's even more important now than I did a week ago that we move quickly to a more neutral stance.
But, I mean, you were in the meeting for 2 days and you heard the deliberation of your colleagues. Most of them don't seem to feel the same way you do. Is that right? Is that accurate to characterize?
I think that's right, and I think that it's fair to characterize my view as in some ways out of consensus. I have no problem disagreeing with people when I come to a conclusion based on analysis of data, based on analysis of economic models, and then I give my view. And I have no problem giving that view if it differs from the views of other people, whether they're my colleagues or not. And so I don't think it's unfair to sort of describe my view as out of that consensus in some ways. But I think in other ways it's very inside consensus. If you look at sort of the what people call the dots, right, the summary of economic projections. The only real material divergence between me and I think the rest of the committee is on how quickly we get to neutral, right? And so I wanted to get to neutral relatively quickly. I think a lot of other people have us getting to neutral also, but just maybe a little bit more slowly. And part of that difference, right, on the fact that I want to get there more quickly than others is because I'm less concerned about upside inflation in the near future, which then gives us the flexibility and the freedom to get there, I think more quickly.
What is neutral? And how do you know what that level should be? Yeah,
so that's a great question. I think we have to acknowledge that these models, so you can't observe neutral, right? The neutral policy rate is the rate at which monetary policy is neither restrictive nor accommodatory. It's you're not slamming the gas, you're not slamming the brakes, you're sort of just coasting along. And if you're below neutral, you're stimulating the economy. If you're above neutral, you're restricting the economy, you're holding it back. And I think it's important for us to understand that the models that estimate neutral tend to give us wide confidence bands. So there is some difficulty in knowing exactly where neutral is at any moment in time. However, I think it's a little bit easier to think about arguing from changes to neutral. And we know that there are some economic factors that push neutral higher, and we know that there are some economic factors that push neutral lower. And so recognizing that there's uncertainty about exactly where neutral is at any moment in time, to me, doesn't mean that we can't argue, we can't reason about where it's moved recently. And In my mind, the economy has experienced some very substantial shocks in the last few years, the types of shocks that normally would have taken decades to unwind. And usually people will think that neutral moves only very slowly, that the neutral rate moves only very slowly, at a very glacial pace, because the things that drive neutral also move very slowly. And so think, for example, population growth, right? Countries with high population growth rates tend to have high interest rates, and countries with low population growth rates tend to have low interest rates, right? That's because population growth helps determine the neutral rate. Population growth is normally something that changes extremely slowly, right? You get changing fertility rates due to cultural changes or due to changes in medical technology that make people get married later or have fewer children or not get married at all. And so as a result, population growth will decline very, very slowly over the course of decades. But due to the sharp changes in immigration policy, we experienced the largest population growth shocks in our lifetimes in both directions, upside and downside, in rapid succession. We experienced population growth shocks in 3 years that normally would have taken 30 to 40 years. And so, to me, while I think it's important to be humble about knowing exactly where neutral is at any moment in time, I think it's easier to say that we know some of the drivers of neutral, and we can sort of observe what happened to those drivers.
You said that you are still very restrictive on rates, which is also kind of a point for debate, because the economy is doing very well. So where do you see it being very restrictive?
Well, the economy was weaker in the first half of the year versus where it had been last year.
That was trade, wasn't it? Imports and exports, stocking up before the tariffs.
Well, it was potentially related to trade. It was related to trade, to some front running of tariffs. It was related to some uncertainty around trade and taxes, I mentioned before. But I do think other elements of core underlying domestic demand were weaker in the first half of the year than they had been in last year. Thus far, for the third quarter, we have very little data to give us indications for the third quarter. But I also think that the labor market has clearly weakened somewhat over the course of the year, and the unemployment rate has ticked up. Has been moving up gradually in the recent past. So, and then you sort of look at something like the housing market, right? And housing is one of the biggest, if not the biggest transmission channel of monetary policy into the real economy. And that has been, I think rather moribund for a while now. On
high rates, mortgage rates.
Largely on high rates, yeah.
But if the Fed lowers rates, it's not guaranteed that mortgage rates will come down. We didn't see that last year.
So that's a great point. And so, last year, I thought that cutting was the wrong move, right? And it's related to this neutral rate conversation we were just having. So I thought last year the neutral rate was much higher due to a variety of factors, including things like population growth being higher, including things like deficits being wider, that raised the neutral rate. Which means that if neutral was here, so if keep policy here and neutral's up here, then I think that policy is not very restrictive. And so I thought that cutting last year wasn't necessarily the right move. If neutral has come down and you keep policy here, then the distance between them has grown. And so therefore policy became more restrictive, even though you kept the nominal rate relatively similar. And so that, in my mind, is reasons for cutting. And so that's why I thought last year it was a mistake to cut, and this year it's the right move to cut.
And the market told you that, and you think this year market will go along.
Exactly. So in the, I think, 18 trading sessions since we cut rates in September, long yields are, I think, like 4 or 5 basis points down. In the same 18 sessions after the Fed cut rates last September, they were up by approximately 30 basis points. And then they went from starting from 30 to go all the way to about 110 basis points up.
So it's working.
So I think last year the bond market told you that cutting was a mistake, and I think that bears out that I was right. And this year, thus far, the bond market is not telling you. No, it may yet, right?
Sure.
But thus far, it's not telling us that we're wrong to cut.